Mohamed, great to have you back on In the Loop.
Thank you, Betty.
Now, I wanted to first off talk with you about Greece, but let me bring in actually what's going on here in the oil markets, because you have an interesting take about what this means that the IEA is releasing these reserves.
Yeah, what we're seeing, Betty, is governments are getting sucked in more and more into markets. So phase one in the fourth quarter of 08 and 09 was about governments normalizing markets. Phase two, 2010, August, when Chairman Bernanke started talking about QE2,
right,
was about governments trying to push up valuations in order to make us all feel wealthier and get us to spend more. But they ended up getting both good and bad inflation. So phase three, and today is an example of that, is governments coming in and trying to distinguish between good and bad inflation. The problem with all this is that markets get very nervous when a non-commercial player comes into the market, and you're seeing that today.
Because governments traditionally fail at managing markets properly, is that right?
And they have a different objective function. It's a little bit like introducing a new player on a playing field that has a different game plan completely. So you get a certain amount of nervousness among market participants because you have someone who's big. After all, they have the power of regulation, of a printing press.
Right.
You get someone that has a different objective.
And Mohamed, you can see that clearly, not just what's going on today in the oil market, but clearly what is happening in Europe, which you say has basically been reduced down to a situation of bad choices.
Yeah, I mean, at PIMCO, we like looking at what are the fundamental issues. And Greece, unfortunately, has two fundamental issues. It has too much debt, and it cannot grow enough. What the response so far has been, let's treat this as a liquidity problem, not a solvency and a growth issue. So a year into a massive bailout, every indicator in Greece is worse off, and other parts of Europe have gotten contaminated, including the ECB. So if you continue with this approach, which is treating Greece as a liquidity problem, not a solvency problem, not only do you not solve it, but you risk contaminating other parts of Greece.
So that's why you say, Mohamed, that basically the only way to work yourself out of this, or for Europeans to work themselves out of this, is through a default in Greece. Is that right?
Through restructuring. So recognize that the problem is a solvency issue, address it, and then try to safeguard other parts to minimize fundamental contagion. We will get technical contagion, but technical contagion tends to be temporary and reversible. What Europe should be doing and working very hard at is minimizing fundamental contagion.
What do you mean technical contagion? What do you mean by that?
So, for example, look at the markets today. You have a very broad-based correlations. Everything is selling off. So you tend to get periods where markets don't differentiate. They are technically contaminated. But those sorts of events don't last very long because people like us come in and buy good fundamental stocks, bonds that are under pressure for technical reasons. So technical contagion is to be expected, and the markets can sort this out. What Europe has to do is to minimize the fundamental contagion, which it hasn't been doing. Look at what has happened to the ECB's balance sheet. That has now gotten contaminated.
Right, because they're holding some of these basically stinky debts that the private bondholders are paying as well. So in a technical contagion scenario then, Mohamed, what has to happen?
Technical contagion, just allow it to play out. Market participants understand what that is. There will be a disorderly process for a while, but markets will find their footing, right? The critical thing is not to contaminate the whole system. And that's what we're risking day in and day out if we continue with a liquidity approach for a solvency issue.
But Mohamed, does that involve then eventually the breakup of the euro?
No, Betty, it doesn't. And what Greece is doing, it's distracting attention from the fact that other parts of Europe are fine. Germany is fine today, right? So there is a strong core with weak peripherals, and what's happening is the weak peripherals are contaminating the strong core. So if you could deal with the weak peripherals, the core is strong, and there's no need to undermine the integrity of the Eurozone and the integrity of the euro.
Mohamed, just quickly before we head to break, and I know I'm asking you to speculate on this, but if we were to have a technical contagion, so to speak, right, something that maybe what we saw, in Argentina, how long before it plays itself out? Essentially, the scenario that you're talking about, how long would it take?
Argentina is a really good example, Betty, and I remember it vividly. So go back to 2001. Argentine bonds ended up the year down 65%. The index for emerging markets as a whole ended up flat. And if you had just excluded Argentina from your holdings, you were up 20%. That shows you how quickly the markets can start differentiating once the main problem is contained, right? So the critical thing is to contain the main problem rather than let it fester and contaminate other things.
Right before the break, of course, we were talking about how governments are now in this third phase, right? And they're being forced to manage in some ways, or to manage, in the markets. And you might look at Ben Bernanke and say that that is exactly the position that he's in, that perhaps he's facing, like in Europe, a series of bad choices.
He is, and I was a little bit surprised that he didn't go further yesterday. So he said the slowdown, and remember, they've revised down not only this year's growth rate, but also next year's growth rate.
Yeah.
He said the slowdown is partly due to temporary factors. At PIMCO, you've heard Bill Gross say it, you've heard my colleagues say it, I've been saying it. The U.S. faces structural headwinds. In order for us to regain a fast growth rate and lower unemployment, we have to overcome 4 distinct structural headwinds. And the Fed is only slowly starting to recognize that. So yesterday was a first step towards that, but unfortunately it wasn't a big enough step. And we need to make that step if we are going to get growth higher and unemployment lower in the United States.
Mohamed, this is Michael. Is there anything the Fed, you heard Ben outline the steps that they still have on their plate, anything they could do that would address any of those structural problems or do any good at all?
They need help, Mike. They need help from other agencies. If you look at what the 4 structural issues are, first it's housing. The housing market is not functioning properly. It's bank credit. It is public finances. And it is the functioning of the labor market. These are things that are outside the domain of the Fed. So expecting the Fed to do all the heavy lifting is too ambitious, right? The Fed needs help of other agencies, and other agencies have not as yet stepped up to the plate in a coordinated fashion.
So, Mohamed, then it sounds like what I'm hearing from you is that there really should be no QE3 on the table right now.
Yeah, even QE2, it's interesting that Bernanke made the distinction yesterday. QE2 was there to increase valuations, asset prices, with a view to getting growth higher. So what we got is the first phase, but we didn't get the second phase. And that's not surprising, because in order to get the second phase, you need to overcome these structural impediments. So now the economy is in this very uncomfortable position where we have a wedge between fundamentals that are down here and valuations that have been pushed up by QE2. So QE3 would be also unlikely to meet the ultimate objective, which is a better economy. And Bernanke has been clear about this. He said, if you look at the equation benefit, costs, risks, the balance has shifted away from benefits and towards cost and risk.
Mohamed, it's Jon Erlichman. Clearly the story of the day has now become crude and oil, just generally because of what the IEA announced. Everyone's forced now to rethink where they see oil over the next few months. Where do you see the price of crude oil 3 months from now?
John, I suspect a lot will depend as to whether this is a one-step process or whether the IEA and the consumer countries are trying to give a much bigger signal. If you look at the numbers, they are releasing just over 60 million barrels. Daily consumption is over 80 million barrels. So it's not a huge issue. But what markets are worried about is the signal of government involvements, because it's very hard to predict the actions of a non-commercial player in a market. So what I would tell you for sure that over the next 3 months, we're going to see a tremendous amount of volatility, not only in oil, but in a lot of other asset prices.
Well, Mohamed, Michael, again, companies have a lot of cash on their books. This is only going to help profit margins if energy costs go down. What's it going to take to get them over the hump, to get them hiring, to get them spending again?
Critical question, Michael. If you look at the global economy, there's lots of cash available. Our old colleague Paul McCulley had a wonderful phrase for it. He said, there's the wallet, but not the will. So you got to get the will in there. It's not a question of wallet when you go to the multinationals, when you go to the middle and upper income households that are doing fine. It's a question of will. And for the will to be there, you need greater clarity. You need greater clarity about a few things: the outlook for global growth, what's going to happen with the European crisis, and what do policymakers want to do. Until we get that clarity, I think a lot of people will be keeping the cash in their pockets, unfortunately.
So, Mohamed, give me your vision then. If we're going to have more nervousness and uncertainty then in the markets and all asset prices, what's your vision in the next 3 months of what's going to happen in equities, what's going to happen in bonds?
You know, Betty, it goes back to the phrase that you've heard a lot of my PIMCO colleagues say, the bumpy journey to the new normal, right? This is the bumpy part of it, right? People are starting to recognize there are some major realignments going on. So over the next 3 months, we are going to see unusual amount of volatility in the market. We're going to see the political process get more involved because the longer unemployment stays, and today we haven't talked about it, but today's numbers were really worrisome.
Yeah.
This is 11 weeks now where we've had the claims number over 400,000. You're looking at a 4-week average of 426,000. These are horrible numbers, right? So it's going to be a volatile and messy process, and people should have dry powder because there will be lots of opportunities to pick up good assets at cheap prices.
Okay. Cash on hand, key. Mohamed, great to talk with you again, to have you back on the program. Really appreciate you joining us. That was Mohamed El-Erian, the CEO of PIMCO.